Okay, let me talk a little bit about if you have a personal loan on a property that you want to transfer into your LLC. So here's where things can get tricky. Transferring your property to an LLC can invalidate the mortgage loan and owner's title insurance policy you signed in your name, because many mortgages include a due on sale clause that can force you to pay the full mortgage amount immediately if you transfer the property incorrectly. So make sure you involve your lender in the process before you even initiate any transfer. Welcome to your Landlord Resource Podcast. Many moons ago, when I started as a landlord, I was as green as it gets. I may have had my real estate license, but I lacked confidence and the hands-on experience needed when it came to dealing with tenants, leases, maintenance, and bookkeeping. After many failed attempts, fast forward to today, Kevin and I have doubled our doors and created an organized, professionally operated rental property business. Want to go from overwhelmed to confident? If you're an ambitious landlord or maybe one in the making, join us as we provide strategies and teach actionable steps to help you reach your goals and the lifestyle you desire, all while building a streamlined and profitable rental property business. This is your Landlord Resource Podcast. Hey there, landlords. Thank you for tuning in to the Your Landlord Resource Podcast. Today, we are talking about something that many landlords who want to hold their rental properties in an LLC often ask. And that is, how do I transfer my rental property that is owned by me personally into an LLC? And let me start by saying that this is not about how to determine if you should hold your rental investment under an LLC. We already did a podcast on that. So if you want to know more about if an LLC is right for you, go back and listen to episode 16. We'll even link it in the show notes to make it easy for you to find.
Yeah, that's actually a good place to start, and it's one of our top 5 most downloaded episodes, I believe.
Yep.
It's got a ton of good information in it. But as a quick review, a limited liability company, or LLC, is a business structure that effectively creates a private business entity. This structure protects business owners from personal responsibility for its debts and other liabilities. That way, if the business falls into debt or faces a legal settlement, creditors can't come after your personal assets, such as your home, car, and financial accounts. Hence the quote unquote limited liability in the limited liability company. So, Stacy and I have had to deal with transferring property into an LLC a couple of times and actually moving properties into and out of an LLC. And why do we want to do this? As I mentioned, LLCs offer better protection than just holding the property in your own name. It also allows you to easily have multiple owners, which can be helpful when it comes to financing a property. LLCs offer privacy, so the LLC is who shows up on public records, not you personally. So let's say you already have your new LLC all set up and you want to buy an investment property. Can you buy it under the name of your new LLC? Possibly. And usually only if you're only paying cash for that investment. It may be difficult to qualify for a loan under an LLC who has never filed tax returns and doesn't have any established financial records. Most of the time, if you have to take out a loan, you'll have to purchase the property in your personal name or the names of the persons who will be the owners and managing partners of the LLC, and then transfer the property into the LLC. Sounds easy, right? Not exactly. First, you need to determine which deed form you're using, a warranty deed or a quitclaim deed. So, when you purchased the property from the previous owner, you likely were issued a warranty deed through the title company. This deed guarantees the title was transferred free and clear, meaning there was no tax or service liens on the property that needed to be paid for. A quitclaim deed requires no title company to research and guarantee the title is clear and good. It simply transfers ownership. Which one you choose is up to you, just so long as you know that a warranty deed may cost you some fees from a title company to process it, where a quitclaim deed is speedy and costs very little.
And one thing to note is that if you opt to not do a warranty deed, but choose a quitclaim deed instead, you must know for certain that there are no outstanding liens on the property, or else you're going to be transferring those liens to your LLC to have to deal with. And also, when you are completing the forms to make the transfer, you need to make sure that your name and the names of all the partners matches the legal documents as well as the LLC name exactly. If the LLC is purchasing the property from you, you will need to disclose the purchase amount. And this is likely going to affect property taxes as they're going to be reassessed. If there is no purchase and it's just a straight transfer, you'll need to check with your county office in charge of recording deeds for any requirements. Additionally, make sure that you complete all of the proper signature requirements, such as signing in front of a notary or having a separate party, such as a registered agent, sign on behalf of the LLC. So, quick side note here, you would be using a registered agent to sign on behalf of your LLC if you decide to create your LLC in another state where you do not reside. Well, I guess you can hire one to use in your own state as well if you really need to keep your business address private. You see, an LLC must have a physical business address. You cannot use a P.O. box. You need to pay a representative who lives in the same state as your LLC to be able to receive mail and legal correspondence on behalf of your LLC. And then they have to be able to relay important messages to you as the owner in a timely manner. These important messages would include government notifications and tax and legal correspondence. You can list yourself only if you're able to receive the notices and act upon them, and this is usually only when you create an LLC in the same state that you reside in. The cost for a registered agent lands somewhere in the range of around 50 to $300 a year. All right, let's get back to the deed. In order for the deed to be recognized, you're going to need to file the paperwork with the appropriate office, which is most likely going to be your county recorder's office. There may be fees associated with registering the deed, and you will need to check with your local county offices for the specific information that is needed. And the average rate for recording a deed is around $125. Not so bad, right? Well, let's not forget about transfer taxes because LLCs are formed at the state level. Each state carries its own rules and regulations for transferring property into a business structure. Many states find ways to charge upfront or ongoing fees or levy special taxes on real estate investors trying to take advantage of the benefits that LLCs offer. For instance, New York imposes a real estate transfer tax of 0.4% for properties valued up to $3 million and 0.65% for properties above $3 million. Florida imposes a documentary stamp tax of 70 cents per $100 in property value when you file certain documents during this process. So, when you're talking about a piece of rental property, these small percentages can add up to a sizable expense pretty fast. So, make sure you know what to expect in your state.
One thing to consider are the tax implications. But for the most part, owning property under an LLC should open you up to many tax benefits that you aren't able to take advantage of when you own investment property under your individual name. The good news is that the IRS treats single member LLCs as pass through entities, meaning the income and losses from LLCs pass through to the members' personal tax returns. Now, unlike with a corporation, with an LLC, you don't pay a separate federal corporate tax rate on your business profits and then get taxed again on any income you draw from the business. In other words, if you are the only member or owner of the LLC, you pay federal income taxes on your profits as though it was direct personal income. Nice, clean, simple. And side note here, if you already do or plan to own an LLC, we highly recommend that you use a CPA to file your taxes. There are a lot of tax advantages you could lose out on if you don't. CPAs know way more about the loopholes and how to make sure you are compliant and thus keeping you out of the IRS's watchful eye. Let's say you do not already have an LLC established but are interested in creating one. We have partnered up with Nolo Legal Forms, and they have a program where you can essentially plug in all your information and it will walk you through all the steps of creating your LLC in whatever state you want. Packages start as low as $49 plus the state filing fees. They make setting up your LLC very easy, so we'll link them in the show notes for you to check them out. So, Stacy's family owned an LLC of which she was part owner of. When the other partners wanted out, Stacy bought them out, and all of the other owners' shares in the LLC were transferred to her, and she became a single member LLC. Essentially, she did not have to take out a loan, but rather created, in a sense, like a seller financing deal with the other partners, that she will pay them X amount of money per month for X amount of years until the note attached to the LLC is paid off. Okay, why does that matter? Because when there is a transfer of ownership, regardless if it's already in or going into an LLC, and if that transfer of ownership change is more than 50%, there is a chance of the property being reassessed for property taxes. For us, because there was a significant increase in the value of the properties transferred, and her transfer took place in California, which meant her property tax base went up quite a bit. And yeah, this stinks big time. However, the new tax basis helps with estate planning for our heirs, so there's that benefit, I guess. Can I tell them how much you pay?
Why don't we just say that 2 full months of gross rents goes to property taxes?
Yeah, pretty crazy, right?
Yes, very.
So then consider the additional cost of liability insurance, utilities, labor, debt service, reserves. It goes on and on. I mean, we do okay with these properties, but man, it seems like a lot more goes out than comes in some months.
Funny how that works, huh? I'll be transparent here and let everyone know that our reserves for taxes and insurance on this property alone are just over $25,000 a year. That does not include reserves for vacancy, repairs and maintenance, or capital improvements like a new roof. Those reserves are another $25,000 and don't include utilities, fees, or labor that we have to pay to maintain the property monthly. But Kevin's point is that you really do need to make sure that you're working with a CPA who specializes in real estate investing so that when circumstances like the one that I was a part of came up, I was able to be advised on how best to process it. Okay, let me talk a little bit about if you have a personal loan on a property that you want to transfer into your LLC. So here's where things can get tricky. Transferring your property to an LLC can invalidate the mortgage loan and owner's title insurance policy you signed in your name, because many mortgages include a due on sale clause that can force you to pay the full mortgage amount immediately if you transfer the property incorrectly. So make sure you involve your lender in the process before you even initiate any transfer. They'll let you know whether you can transfer the property title under your existing mortgage and what fees or interest rate adjustments, if any, you're going to incur. While I'm not saying it's a good idea, there have been real estate investors that create an LLC named after themselves, such as Joe Smith LLC, in the hopes that the mortgage lender simply won't notice the subtle change in ownership. And where it may work, there's no guarantee, and you risk the mortgage company calling the loan. Because when you transfer property to your LLC, you are effectively selling it to your LLC. Generally, when you sell a property, you're required to pay off the mortgage and any other debts secured by that property. Whether you can transfer your mortgage to an LLC likely depends on your mortgage agreement and your lender. Depending on your type of loan that you received, Your lender may not be as receptive to transferring your mortgage. Some may allow you to do so, but only after refinancing and potentially securing the loan with a personal guarantee from you. You see, your personal mortgage that you take out on a rental property typically is personally guaranteed by you. When you transfer that property into an LLC, your personal guarantee goes away, and essentially the risk for the lender goes way up because they have no one to go after if you default. If your mortgage was intended for your personal or primary residence rather than for a rental property, the lender may require you to modify your loan. Primary residences enjoy more legal protections than rental or commercial properties, which enables lenders to provide more favorable terms for these loans. Most mortgages allow lenders to accelerate payments on the loan and demand repayment in full immediately if a borrower violates its terms, such as by converting a primary residence into a rental property. In this situation, you may be able to refinance with a new lender, or your LLC may secure a new loan to pay you to satisfy your prior mortgage. I have to say, this is not a time to be sneaky. Transparency is key here. Get all your ducks in a row and make sure that the lender is on board before you go and create your LLC.
Okay, so let me say that we've been told, and I have no idea to the truthfulness of this next statement, but if you've been paying your loan on time for several years, many lenders will work with you. Now, that came from a mortgage broker we know, but I guess he speaks for the banks and lenders he deals with, so who knows how valid that is. Okay, so one thing I want to address is if you have a 1031 exchange that you have done to acquire your current rental property. Can you, by IRS rules, transfer that into an LLC? Well, because the whole issue behind a 1031 exchange is that the original title must transfer with a 1031 exchange for it to be valid. When we bought our Idaho property, that was through a 1031 exchange from some land I inherited from my grandmother like 30 years ago. Title was in my name only, but when I wanted to buy in Idaho in order to qualify for the large loan we needed at the time, I had to add Stacy on, which is allowed given that the original amount 1031 exchange was less than 50% of the value of the new property. I know that sounds confusing, but here's an example on how that can work. Let's say I'm exchanging a property that is in my name only and sold for $250,000, and I'm buying a property valued at $1 million. That $750,000 difference is more than the amount exchanged. I'm able to add another person on the title. As long as the amount exchanged is not greater than 50% of the value of the new property, you can add someone to title. And this is important to know because if Stacy and I want to create an LLC to hold our joint properties in, both our names need to be on title and both our names need to be on the managing partners of the LLC. So for us right now, it does not make sense to transfer the property into an LLC because we aren't entirely sure we're going to hold this particular property long term. And if I'm being honest here, if we do decide to exchange the property again and we need to get a loan on the new property, it is much harder to qualify for a loan through an LLC than personally.
Plus, commercial interest rates for LLCs tend to be higher than for individuals.
Yep, there's that aspect as well. So, the biggest issue with transferring a 1031 exchange property that you bought personally into an LLC is the change of title. The IRS is very strict about this, and the basic answer is no, you cannot. But, and you knew there was one coming, there are some exceptions. Timing is the big issue. It is not recommended that you 1031 exchange a property and then immediately or within a few months transfer title into your LLC. The IRS does not take kindly to this. If you must change ownership, the general rule of thumb is to hold the replacement property for 1 to 2 years before doing so. Otherwise, the IRS could disallow the exchange and you could end up with an unexpected capital gains tax bill and those aren't any fun. The IRS isn't trying to put more red tape into a 1031 exchange situation by making ownership changes so complex. The rules are in place to ensure that the parties involved in a like kind exchange aren't trying to avoid tax liabilities. Just know that it is possible to make a title exchange following a 1031 exchange, but doing so can be complicated, requiring certain and specific steps. So, if a title change is on your mind, be sure to check with a qualified tax consultant or your CPA to determine your options.
Yeah. And the good news is if you are going to hold your 1031 exchange property long term, you can transfer title into your established LLC after a couple years. And if you want to do another 1031 exchange with it down the line, you'll just need to do the exchange under the title of the LLC, not your personal name. So you can see that where the process is relatively simple, especially if you already have your LLC established, there are some pros and cons to it. Now, if you can transfer rental properties into an LLC, that must mean you can also transfer them out, correct?
Yep, and you did that as well.
I did. I am selling one property that I held in my LLC a few years ago. And notice how I said held? My LLC shows quite a bit of debt service. And because I owe the other owners for the purchase of their shares, the LLC holds a rather large debt note. It does not appear to be as profitable as banks would need for the LLC to qualify for a loan on a new property. So I did what is called a drop and swap. I dropped the property out of the LLC and swapped it into my personal name. Now, the reasons behind this can be that I'm going to gift it to a child or remove it from the rental market so a family member can move in and live there rent free, which was the intention originally. And the IRS allows you to do this. But again, much like with a 1031 exchange, you must hold it in your personal name for a couple of tax seasons before changing title, 1031 exchanging it, or outright selling the property, which is what I ended up deciding to do. I will sell the property in my personal name and possibly pay a small amount of capital gains on the sale, but then I can take the capital from that property that has no debt service on it because the LLC is essentially paying for that debt and use that capital as a significant down payment on another multifamily property. I'll be able to qualify for a loan easier and likely get a lower interest rate too. Then I can hold that property for a few years in my personal name, and if all goes well, transfer it back into the LLC to hold for the long term. You might need to go back and listen to that part again, but the long and short of it is I am able to use 100% of the proceeds from the property that is essentially not debt free to scale up and buy more doors.
Wow, talk about creative financing.
Yeah, well, we have an amazing CPA.
Yeah, a really great guy, and he really knows his stuff when it comes to real estate investing and taxes. We have said this before and we'll continue to drill it into you guys, but much like when you search for a property manager, find people for your team that have an in depth knowledge either by work experience or who are also real estate investors themselves. When you do, you'll find a completely different relationship and dedication to your investment business than you would from those who don't have this experience or knowledge. Okay, before we wrap up on this episode, I want to touch on a few other things to consider before you transfer your rentals into an LLC. First, your liability insurance will likely need to change, especially if this property was held as a personal residence and then became a rental. Much like your mortgage lender, insurance companies have provisions in their policies that rental properties held under an LLC need to change to a commercial liability policy or your coverage may be voided. The reason being is the coverage is not only for the property, but for the business as well. And because your brand new LLC doesn't have the credit history you do, you may not be offered the same rates on a new insurance policy, so there's that to consider as well. And lastly, you'll need to update all related paperwork particularly any lease agreements. Moving forward, your tenant should be paying rent to a separate bank account owned by the LLC and no longer to you as an individual. The more separated your finances are from the LLC, the more liability protection there is for your personal finances. So, if you use a property manager to handle your leases, you'll have to pay them a small fee to reissue and handle getting signatures for your new leases as well.
Yeah, there's a lot of things to consider when transferring your rentals into an LLC. And as an afterthought here, if you hold your property under an S Corp, you can transfer it to an LLC as well. Well, actually, you can transfer the property or you can just convert your S Corp to an LLC. When transferring it, the S Corp will have to state if there was a loss or gain. And there's a bit more to it, but bottom line, it can be done. Likely, if you hold your property as an S Corp, you already have a good CPA to support you. So lean on them for advice on how and when to transfer or convert your rental from an S Corp to an LLC. Okay, let me wrap it up here. Transferring rental property to an LLC offers real estate investors protection for their personal property, tax flexibility, and organizational clarity. The drawbacks include potential costs and less flexibility when it comes to financing and selling the property. Unfortunately, the rules vary so much from state to state that it's impossible to cover them all here to provide a one size fits all recommendation, other than to consult with a real estate attorney or an accounting professional in your state who understands the tax laws that apply to you. And we just want to say thank you so much for taking the time out of your busy day to listen to what we have to say. It really does mean the world to us that you find our content useful. So, Kevin and I are in the process of creating a new course called From Marketing to Move In: How to Place Your Ideal Tenant. And we have opened the wait list for anyone who might want to learn more about it. We'll link it in the show notes for you. We'd love to connect with you outside of the podcast. So check out the show notes for links to our free weekly newsletter, private Facebook group, and our social media sites. Again, thanks so much for tuning in. And until next time, you've got this, landlords.